Hello. In this presentation, I'm going to look at the circular flow of income. The circular flow of income is a diagrammatic representation of the economy, the main players, the terminology, and some of the approaches that might be adopted by governments in an attempt to manage the economy. Whilst this is not intended to be a detailed economics lecture, it will provide an overview of the economic environment within which companies operate and highlight how actions taken by governments can affect the operations of companies. Specifically, this presentation will cover the economy in its simplest form, monetary policy, fiscal policy, balance of payments, and other policies. Let's look at each of these in turn. The economy in its simplest form. In its simplest form, the economy has two players: firms who manufacture goods and households who supply the factors of production, such as labour and capital. To show this diagrammatically, households supply labour to firms, which in turn allows firms to manufacture goods which they supply to households. As goods and services flow in one direction, the associated money flows in the opposite direction. As such, households receive wages in return for supplying their labour, and this means they can pay for the goods provided by firms. This is referred to as consumption. For this presentation, we are only interested in the flows of money. We now have a continuous circle of money flowing around the economy, and this represents the size of the economy. Governments will want to grow the economy, i.e. the volume of money flowing around the circle, and increase employment. However, they will wish to avoid creating inflation, which arises when households are demanding goods at a quicker rate than firms can supply them. Governments can attempt to address inflation using either monetary or fiscal policies, and we will now look at each of these in turn. Monetary policy. As discussed above, in simple terms, inflation is caused when demand outstrips supply, and consumers end up competing for limited supplies, which pushes prices up. In response to this, governments will want to stop consumers spending, and one approach is to encourage them to save instead, which they can do by increasing interest rates. To reflect this aspect of our diagram, we need to introduce a new player to the economy: banks. Banks and other similar institutions take deposits from savers and use these to provide borrowings to lenders, both households and firms. Governments, through central banks, may choose to take some of the money saved out of circulation, thereby reducing the money supply, the amount of physical money in circulation. This combination of using interest rates and the money supply to control inflation is referred to as monetary policy. High interest rates can impact on companies in a number of ways. Sales may fall as consumers save instead. This is likely to affect companies providing luxury items more than those providing necessities. The cost of borrowing for consumers will increase, which may reduce disposable incomes. For example, the cost of existing loans may take up a bigger proportion of their income as interest rates rise. And this will make it harder for consumers to afford large items for which loans may be required. The company's own borrowing will be more expensive, which may make the investment in infrastructure more expensive. Fiscal policy. An alternative approach that governments may adopt in an attempt to reduce consumer spending is to increase taxes, such that households have less disposable income. The money generated by the government can then be used to redistribute wealth by providing benefits to households or stimulate sectors of the economy through government spending. For example, if the government decides to build a hospital, not only is this a worthwhile project in its own right, but will also create jobs in the construction industry. There are, of course, other things that governments can spend money on. However, these are the key choices in this context. From the perspective of firms, their sales and profits are likely to suffer as disposable incomes fall, and this will hit hardest at firms who provide luxury products. Balance of payments. Balance of payments refers to the relative size of imports and exports. Given that we are focusing on movements of cash as opposed to goods and services, exports are an inflow to the circle, whilst imports are an outflow, as money is paid to overseas firms in return for goods purchased. As such, it is extremely difficult for a country to continue long term in a situation where imports exceed exports, and this situation is referred to as a balance of payments deficit. Faced with this situation, governments may try to make our exports more attractive to foreign customers and imports from foreign suppliers less so by manipulating exchange rates. Clearly, this will be helpful to companies trying to export their goods, however, can equally increase the costs of firms who import raw materials. Governments could also try to artificially increase the cost of foreign imports by charging import duties or levies. However, their ability to do so may be challenged, for example by the World Trade Organization, and this aspect is not considered further here. Finally, governments could attempt to reduce consumer demand overall. However, given the previous paragraph, this may affect domestic firms as much as foreign ones. Other policies. Finally, there are other government policies that could potentially impact on the decisions and actions of firms. These include competition policies that may veto acquisition or mergers on the ground that they would afford the firm too much power and be bad for consumers. Environmental policies may force companies to change processes or to build in safety checks to existing processes. Either could increase the operating costs. Conversely, governments may offer consumers grants, for example for loft insulation. These may create an opportunity for firms able to offer such services. Finally, health and safety policies and employment legislation may also require process changes and increased costs. However, could also provide a competitive advantage for firms who already have high standards in these areas. Thank you.
In this video, I will go over the nature and role of financial markets and institutions. Financial markets are where financial securities like stocks or bonds can be bought and sold, and commodities can be bought and sold. High value commodities like, say, gold. Financial markets are where those who need funds can meet those who have funds, and they will supply these funds for a return. So a company who needs to raise money can go to the financial markets and sell securities or bonds that offer a certain rate of return. Investors will buy these securities if they meet their required return. Financial markets facilitate organisations to raise capital, to manage risk or transfer it. For example, like foreign exchange risk can be managed with the derivatives market. International trade, so by enabling organisations to buy foreign currencies in the currency markets, enabling them to trade internationally. As I already said, match those who need capital with those who have it. Capital and money markets. So what are capital markets? They are where debt and equity are traded. They are markets where longer-term investments are sold. The organisations who seek finance from these markets are seeking long-term finance. The main securities sold in capital markets are public sector and foreign stocks, company securities, and Eurobonds, also called international bonds. These are bonds that are in a currency that is not the national currency of the issuing company. So a US company could issue an international sterling bond. There are national and international capital markets. National markets tend to be smaller. International markets enable organisations to access foreign currencies. The main international markets are the euro markets and the foreign bond markets. The euro market is an international capital market organised by international commercial banks, where financial institutions buy and sell currency deposits that are not held in their country of origin. Companies who have a high credit rating can raise finance in a foreign currency. Money markets are used by companies to access short-term funding for, say, liquidity and working capital purposes. They offer investors shorter-term investments where deposits that are not needed now but may be required in a year or so. These deposits can be invested and earn a return for the company or the investor. Financial intermediaries. You now know the financial markets are where those needing finance can meet those who have the funds to invest. But the market is full of all different types of organisation and investor. The role of the financial intermediaries is to bring these parties together. Through an intermediary, investors can put their money and it is invested on their behalf. So the receiver receives the money indirectly because it comes through the intermediary. Typically it works like this. People and organisations with funds deposit their funds with an intermediary. For example, you deposit your savings with a bank. This is an intermediary financial institution who lends out your funds to borrowers at a higher rate of interest that you will earn for your deposit. Although your money has been loaned to a borrower, you will have no contact with the borrower. Examples of financial intermediaries are banks, building societies, finance companies, pension funds, insurance companies, and investment trusts. These intermediaries fulfill the following roles. They aggregate small investors' deposits together to supply a large borrower. So, for example, a pension fund may be made up of lots of investors who have each put in, for example, $1,000 invested. But the total value of all these investors could be $1 million. This $1 million can be invested into one big borrower. Individually, these investors would not have been able to invest in such a big project. Risk transformation. This is where investors' funds are attracted to low-risk securities. They are then issued to the borrower, who is a higher risk. Sound confusing? So, think about a normal merchant bank. They offer you a 3% interest return on your deposit and a guarantee that you will be returned your deposit within 1 week of requesting it. So it is a low risk security for your funds. The bank, in turn, would issue your funds to a high-risk investor. In finance, the higher the risk, the higher the cost of finance, or the higher the return must be for the investor. This high-risk loan will be issued to a borrower at, say, 20%. Your money has been loaned out at a 17% more return than you receive for it. This is because the intermediary is taking the risk. Maturity transformation. Often those who need finance need it for a longer period of time than the investor has the finance available. So take, for example, somebody wanting to buy a house. They save their funds for a year. They deposit these funds with an intermediary for a year. The intermediary issues these funds to a long-term borrower, say for 20 years. Even though the two parties' timeframes are different, it is okay because the financial institution is receiving deposits from other investors when the person who wants to buy their house, the original person, withdraws their funds. Other deposits can be used. So the intermediary in this situation can satisfy the borrower's finance maturity needs and the investor's. What is a stock market? A stock market is also called a stock exchange. It is a collection of markets where equity is issued and traded. The role of the stock market is to facilitate companies issuing equity to investors, facilitate the trading of shares and stocks. The stock market offers security to investors and companies by acting as a clearinghouse for the transactions, which ensures payment from the purchaser of shares and delivering of the shares from the companies selling them or issuing them. Shares can be traded easily on the stock market. This means that investors can quickly sell on their investment, making it more attractive to invest. Here's an example of what can be traded on the stock market. Issued shares of public companies, which are equity, corporate bonds, this is a debt instrument that can be traded as well, it's issued, government bonds, and local authority loans, again debt. What is the corporate bond market? A corporate bond is a form of debt financing issued by a company directly to an investor that offers a rate of return. So the company has issued a bond instead of, say, going to a bank for a loan. These are sold by the corporation to raise finance. Bonds can be secured. This means that they can use a specific asset for collateral. This reduces their risk. Unsecured bonds do not have collateral backing on them. Only the issuing companies promise to pay. Governments also issue bonds called government bonds. Government bonds are considered to be less risky than corporate ones, so offer a lower return. When discussing the rate of return of bonds, you talk about bond yield. A bond is different from shares because it is a debt instrument. When an investor invests in a bond, they will get the yield from the bond, but they will not own shares in the company like they would if they had bought equity in the company. Corporate and government bonds are issued on a specific market, the bond market. This is a primary financial market where companies and governments can issue the new debt. Once issued, they can be traded on a secondary market like the stock exchange. I've touched a little on the concept of risk and return. Investors invest to make a return. When they invest, they must assess the risk of 1. Not making a good enough return, and 2. Losing the funds they invested. Investments are categorized according to their level of risk. The general rule of thumb is the higher the risk, the higher the expected return. Let's go over some common securities traded on the financial markets and the risk attached to them. Treasury bills. These are short-term debts sold by a government at a discount. Because they are short-term, they are considered low risk. Long-term government bonds. The level of risk attached to them depends on the financial stability of the country issuing them. Their value will fluctuate in line with the changes in the country's interest rates. Because they are riskier than Treasury bills, they have a higher rate of return. Corporate bonds. Again, a long-term debt instrument. These are riskier than the previous two because a country is less likely to default on paying their bondholders than a company. To protect investors, bond agreements can contain many restrictive covenants. Bonds are credit rated, and the higher or better the rating, the lower the perceived risk. Secured bonds are considered less risky than unsecured bonds. Junk bonds are risky investments, and their risk of default is high. Therefore, these high-risk investments offer high returns to an investor. Preference shares. You should already be familiar with preference and ordinary shares. Please look back at F4 share capital if you need to refresh yourself. Preference shareholders are paid ahead of ordinary shareholders and often at a fixed rate, so they are less risky than ordinary shares. Ordinary shares carry the most risk, and when a company is wound down, they are the last to get paid. But they also can make the highest returns. Returns and losses are determined by the rise and fall of the share price on the stock market. In this video, I will go over the nature and the role of the money market. The money market was introduced in the earlier section. The nature of financial markets and institutions. Please go back and review this section now. The money market is the global financial market for short-term borrowing and lending. Investments tend to last up to 12 months. Companies and governments issue short-term debt on the money market. They are considered to be secure investments, so offer a low rate of return when compared to the returns offered by long-term investments on the capital market. On the money market, the following can be traded: Treasury bills, commercial paper. These are short-term unsecured debt issued to fund short-term debts of an organisation, like trade receivables. Bankers' acceptances. Another short-term debt instrument that is guaranteed by a commercial bank, similar to a Treasury bill. The money markets provide an important role for public and private sectors. Firstly, by allowing private and public organisations to raise short-term cash for liquidity. For example, to fund short-term payables such as inventory or payroll expenses while they are awaiting cash, for example from the sale of said inventory. These investments are also considered very liquid by investors, so attractive as short-term investments. Companies need to have liquidity in their organisation to enable them to speculate, so take advantage of opportunities for emergencies and for their normal transactions. The money markets enable this by offering liquidity and short-term trade finance. The money markets also allow organisations to manage their exposure to foreign currency risk and interest rate risk. Managing foreign currency risk is covered in managing exchange rate risk. Please look at this section to understand how organisations can use the money markets to reduce foreign exchange risk with forward contracts, futures and options. Managing interest rate risk is covered in Managing Interest Rate Risk section, where this risk can be managed using futures and options, types of derivatives that are available on the money markets. So the money markets offer very important services. But what are the financial institutions' role in the money market? They act as financial intermediaries. Their role was examined in an earlier section, the nature and role of financial markets and institutions. I advise you have a look at it now. The main advantages of the financial institutions is they reduce the cost of the transactions. On an individual level, this would be very high, but financial institutions have large volumes of transactions, so they reduce the transaction costs of the money markets through economies of scale. They can reduce credit risk. For example, an individual with $200,000 to invest will have to engage a specialist or many specialists to assess the credit risk of various investments options. This will be costly and will quickly eat into their investment monies. A financial institution often has access to these specialists in-house and has experience in investing in specific areas, so can produce more credit risk information at a cheaper rate, reducing this credit risk to the investor. Banks and other financial institutions can also convert their illiquid assets into marketable securities and sell them on. These are usually attached to an underlying asset. This is advantageous for the financial institution. In recent years, financial institutions have received a lot of bad publicity for this practice, particularly in countries affected by the recent mortgage crisis. Illiquid assets, such as long-term loans like mortgages for personal homes, can be grouped together and sold as mortgage-backed securities. These are long-term loans backed by the asset, a person's home. The investor who buys this security from a financial institution has the security that if the borrower defaults on their loan repayments, they can sell the underlying asset, i.e. an individual's home. These securities were traded internationally and caused political tensions when homeowners realised that their debt was sold onto an international institutional investor without their knowledge. This conversion of illiquid assets like long-term debt to a marketable security is called securitization. Now you have a clear understanding of what the money markets are. Let's look at what is commonly sold on them. They can be divided into the following categories: interest-bearing, discount instruments, and derivative products. Interest-bearing products are any products that bear an interest to their owner. Examples of these are certificates of deposits, which are abbreviated to CDs. These are certificates for amounts deposited with a bank for a specific time and rate. There are two types of certificates of deposit. They are negotiable, meaning that they can be sold by the bearer before the time is up, i.e. if the bearer needs their deposit back before the deposit's maturity date, they can sell their investment. Then there are non-negotiable CDs. These pay a set interest rate, called a coupon, and repay the capital as normal. They cannot be readily sold by the investor. Repurchase agreements, also called repos, are where two parties agree to buy or sell an instrument at an agreed price and then repurchase back at an agreed price at a set time later. To the party selling the security and agreeing to repurchase it at a later date, it is called a repurchase agreement. But what about the buyer who are buying something that the seller promises to buy back from them in the future? Therefore, they will call it a reverse repurchase agreement. These can be very short term. Bank deposits. These are deposits made to a bank. You should already be quite familiar with these, and they were covered in the previous section, the nature and role of financial markets and institutions. Government securities are bonds issued by a government authority. These were also covered in the earlier section. Local authority bonds are fixed interest bonds that are repayable on a specific date, used by local authorities to raise a loan. These are similar to Treasury bond. A non-interest-bearing security traded on the money market would be a bill of exchange, which is an unconditional promise to pay a specific sum either on a future date or on demand, so it can be called in at any time. They can be sold to third parties after their creation. Discount instruments. Discount instruments don't pay interest to investors. Instead, they are sold at a discount to investors. So, for example, an organization issues a security of $100, available at a 20% discount. That means that it is being sold for $80. On maturity, $100 will be paid to the investor. The difference is the income for the investor. Unlike interest-bearing investments, where investors must wait to receive interest, investors can get their gain at the beginning when they buy the product. The following instruments are discount ones. Treasury bills, which are issued by governments at a discount on their face value. Commercial paper. These are issued by big organizations with a very good credit rating. They are unsecured for a short period of time, usually for 30 days or so. These organizations use them to fund short-term investments. Bankers' acceptance. These are issued by companies like commercial paper, but a bank guarantees them. They are guaranteed because the organization may not have a good enough credit rating to offer a commercial paper. The guarantee makes them more secure, so the return offered will be low, but the organization will have to pay a fee to the bank for that guarantee. These can be traded on the money market before maturity. Derivative products. I have already mentioned that they can be used to manage currency and interest rate risk, but what exactly are they? They are contracts between two parties. Their price is determined by an underlying asset. Assets such as currencies, interest rates, bond and market indexes. The value of the derivative is affected by fluctuations in the value of the asset. There are many different kinds of derivatives. Future contracts, or just called futures, are the most common. They are used to hedge against risk over a certain time. For example, ABC Limited is a UK company that is committed to buying a US shopping mall. They will need to pay $10 million in 1 year's time. ABC's currency is British pound sterling, and they want to use derivatives to manage the risk of dollars going up in value against their base currency, which is British pound sterling. They agree to buy $10 million for £8.5 million, which is the current exchange rate, from Z Limited. Z Limited speculates that the dollar will lose value over the next year and that they will make a profit on this exchange. After 1 year, $10 million is worth £9 million due to the sterling falling in value. This means that ABC has benefited from this forward contract and Z Limited has lost out. As well as future contracts, there are forwards. They are like futures but are traded over the counter and not on a stock exchange, often through dealers. Swaps are another form of derivative where two parties contractually agree to take on the other's, for example, loan liability. So if ABC Inc. is paying 5% fixed rate interest on a loan and they expect interest rates will go below 5%, they can swap their loan rate with QTZ Incorporated, who have a variable loan rate. The underlying loan agreements remain the same, but ABC will pay QTZ's loan and they will get a variable interest rate, and QTZ will pay ABC's loan. If interest rates go above 5%, ABC has lost out because they must pay a higher interest rate. And finally, options. These are similar to futures. The key difference is the buyer or seller can decide not to go ahead with the transaction if they don't want to. An option can be short, where an investor expects the value of the asset to fall. They sell shares of borrowed stock. This works by the investor borrowing shares from a dealer and paying interest for this loan. They sell the shares for the current market price on the open market, receiving cash for their sale. If the share price falls, they will then buy the same amount of shares back and give them back to the broker. The only cost is the interest they paid on borrowing the shares. If the shares increase in value, the investor loses out and owes the brokerage firm. A long option, in contrast, is where the investor owns the stock and expects the prices of the asset to rise. A call option gives the investor the right, but not the obligation, to purchase a stock or a bond, etc., at a specific price within a specific time. That means that the investor gains if the asset value increases from when they put the call in place, because they can access the asset at a lower rate. Or a put option. This is the opposite of a call because it gives the seller of the asset, not the investor, the right, but again not the obligation, to sell their securities at a specific price and in a specific time frame.